Yeah.
I feel good about retirement.
I have one question. Could you explain the difference between what happened in Argentina and what happened in Russia? Because Russia defaulted voluntarily on its domestic debt.
Yeah.
And versus Argentina had lost its dollar debt.
Okay, so if any of you have been to the Fed, you know you start everything off with so. Okay, so what happened in Russia was that they had a fixed exchange rate. The ruble was fixed at 645 to 1. And they were borrowing dollars in order to keep it going because people would rather have the dollars than the ruble. When you have a fixed exchange rate, the dynamic is if you get paid in rubles, you have three choices. You can do nothing. You could buy ruble securities, or you can cash them in for the reserve currency, which were the dollars. And so with a fixed exchange rate, the Treasury competes with the option to convert. And you see that all the time. And so with fixed exchange rates, the interest rates are actually controlled by the market. And so what happened in Russia is as the Treasury competed with the option to convert, interest rates went up and up and up, and finally they were paying 200%, and there was no interest rate where people would rather have the rubles than the dollars, and they ran out of reserves, couldn't borrow any, and defaulted on their conversion obligation. Now, at that point in time, what most countries would do would be just to float the currency and say, okay, look, there are no more dollars. For now on, the ruble's floating, and just keep the money, the central bank operational. What they did in Russia was when they ran out of dollars, they just turned out the lights and went home, shut off the computers, and didn't open up for 4 months later. When they did open up, they went in through the hard drives, and sure enough, the ruble balances were still there, and they basically honored them. There was a little bit of restructuring, but nothing particularly serious on the interest rate side. And so it was a fixed exchange rate collapse or blow up, and they just shut everything down. Now in Mexico, they had the same kind of blow up, and they just what was it 3 to 1, 3.5 to 1, or something like that? Was it 3? It's 3 to 1 back in about '95. They were supposed to honor these Tesobono obligations where you were able to turn these in. They were had them indexed to U.S. dollars, where you could turn in and get it, and they were guaranteed you enough pesos where you could convert those instantaneously into $40 billion. Well, there was no amount of pesos that could be converted to $40 billion, so the whole thing collapsed. And they wound up dishonoring their promises, rolling some into Brady bonds, whatever. But they let the currency float. And so the peso went to 9 to the dollar or somewhere around there. And they kept business as usual with as a floating exchange rate. Okay, so I don't know if that answers your question or not, but that's what happened. Oh, Argentina. Yeah, Argentina was fixed 1 to 1 to the U.S. dollar. Same type of thing. Interest rates went up because of the option to convert. They ran out of dollars, and one night in the deflationary mess that followed, after 32 dead in the street one night, Buenos Aires, they reopened with a floating exchange rate. They let the peso float. Okay, Russia, the difference was when it blew up, they just turned the lights off and went home. They could have kept it going if they wanted to. They didn't know what buttons to push at the central bank, or they were afraid for their lives, the central bankers, and just left. Okay, which is the story I've heard also.
One corollary follow-up question. Can you explain how this relates to the Rogoff-Reinhardt book? That is the debt in foreign currency versus in your own currency, and what these bad numbers, 90% of GDP, have, what that actually means.
Yeah, I mean, I think the lesson to be drawn from the arguments that I made are that the debt to GDP ratio is largely irrelevant so long as the debts have been written in a currency that you have a monopoly over the issue of. So the U.S. government can always meet on time and in full any payment that comes due in U.S. dollars, period. Okay? If you're borrowing in a currency that you do not control, you cannot create, like Greece cannot create the euro. It is prohibited by the Maastricht criteria, Article 104. You can't print money. Okay? So they can't always necessarily service on time and in full obligations that come due. It's not a sovereign currency.
Let me just add to that. If you look at Italy back in the 80s, they had one of the best economies in the world with debt to GDP ratios well over 100% and inflation rates in double digits. Okay, so the problem with inflation is not that there's any real economic problem. It's a political problem. People don't like it, and you will get thrown out of office if you allow inflation. Not because it's not good for employment and output. It's just considered immoral. It's the government robbing us of our savings and hidden taxes and all these types of things, and it has to be respected. And democracy reflects the will of the people.
Keep in mind also that Japan's debt to GDP ratio is roughly 200%. Okay, but as long as the borrowing is done in yen, it's not a problem.
If you read their book carefully, have you read their book?
Sorry.
Have you read their book? If you read their book carefully, you'll see, and you go through each case and trace the currency system that was being run, the circumstances surrounding the default, you'll only find one example of a sovereign, truly sovereign government in modern history that had defaulted, and that was Japan, and it was during the war. And the reason they defaulted was because they said they weren't going to pay back debts to their enemies. And it had nothing at all to do with the question of solvency. It was a political decision. And so, you know, I think the book is being used very frequently now by commentators as see, this is the definitive piece of research. And in actual fact, it's highly limited research, and applies to a very small number of circumstances that we don't find in very many countries.
Look, I've had very strong conversations with David Beers at Standard & Poor's about this. Separating the difference between ability to pay and willingness to pay, right? And so he's, the last time, when was that last go-around? I sent you copies of that. But they have stopped downgrading on ability to pay, I believe. They are now downgrading on willingness to pay, which is what happened with Japan. So what we're saying is there's always the ability to pay. There may not be the willingness to pay. Very different things.
Just to add on to the Argentina story, it's instructive for another reason. Argentina actually is a very good case study of how you launch a currency. When the state was bankrupt, the provinces were bankrupt. What they did is they actually issued their own IOUs. They issued patacones, lecops. There were just varieties of local currencies. Now, our states are prohibited from doing that, but in Argentina, they could. And so you get back to Stephanie's point. I was like, why do you trust a currency you didn't have before, you didn't use before? The vast majority of people are not using. There's no trust that was built in the system. And the reason was because the states taxed the population in these lecops, and then they negotiated that you could pay your utility bills in patacones. And so although everybody was up in arms and saying, you can't be using this system, and granted it didn't last very long, you go to Argentina and you see every store says, aceptamos patacones. It was very effective to launch this currency. Once they floated, they had no need for them anymore.
In Russia, after the central bank shut down, they traded what they called arrears, which is I thought, a fantastic word for what things are. So the corporations would trade arrears with each other.
John Lutz from the great state of New Jersey, or infamous as it currently may stand. I want to thank Stephanie very much for her very clear presentation. I did want to ask you a specific question, though, when you're talking about countries. Everybody believes you, but you see that lurking look in their eyes, and they say, well, what happened to Germany after World War I, or the latest case, Zimbabwe? Could you explain that in clear terms?
No, but I hope Marshall can.
I'll be doing a full presentation.
That is the topic of Marshall's presentation. Will you be staying for the full day? Oh, okay. Well then, I was going to, okay.
Roger Erickson, another question about getting back to Treasury bonds. We've all heard, most of us have heard now that we went off the gold standard under Nixon in 1971. The question that rarely gets asked is, why does anybody bother selling treasury bonds anymore, or at least very many of them? And a follow-up is there any country in the world that doesn't bother doing that to any extent?
It's a law. That's one the short answer.
What happens is when new countries start, they just have what they call central bank credits. But then when they become real countries, then they start using treasury securities, so then they become real countries like everybody else. And even Russia was like that. For years, there was just central bank credits. And so they had a right to begin with, and then moved on to be like everybody else. I've seen that happen many times.
But that doesn't answer the question. Marshall, can you elaborate on why?
It's a legacy of as you say, Nixon closed the gold window in 71. Bretton Woods was completely eliminated in 73. But we didn't sever the legal connections to that system at the time, so that the laws that were enacted in Congress are predicated on that old gold standard thinking, so that by law you have to issue debt dollar for dollar to fund the spending. So it's simply a legal legacy. There is no operational reason for it, and I think one of the things that we have to do at times, and that we don't do well enough at times, is we tend to conflate the descriptive with the normative, and I think we have to make clear to people that, and I think Bill's been very good at this, especially recently. I think the blog from a couple of days ago, that there are certain theoretical aspects which are impeded from happening in an operational sense because of these silly legal constraints, and that happens to be one of them. I mean, one of the things that we've talked about is just having let the Treasury run an overdraft facility with the Fed as opposed to issuing bonds. But there's no real reason for it other than the legal legacy.
I'll just say one other thing, and this is the interest-earning alternative to holding reserves, which in the United States until a year ago didn't pay interest. So what we needed to do was to put in place the alternative that doesn't require selling treasury bonds, and that is to pay interest on bank reserves. So Canada had done this 10 years before, so Canada no longer had any operational reason to sell treasuries, although they may not understand this, and they're still selling treasuries, and it could be a legacy of law also. Now we're in the same situation. Now we're paying interest on reserves, and so we don't need to sell the treasuries anymore for operational purposes, but we still have the law.
From a functional point of view, the reason to sell term securities would be to raise the interest rates for the term structure, and clearly that's not what they want, what they're trying to do.
But you've pointed out many times that only requires very short-term bonds.
Right, but if you want 30-year rates to be higher, if you want mortgage rates to be higher, you could go sell 10-year securities to drive up rates. If that was the public purpose, that would be the only reason you would sell 10-year securities, was to be some public purpose behind having higher 10-year rates. Now, I don't think anybody thinks there is. They're doing it for other reasons.
So I know Bill's going to comment. Could you also just slip in? Is there any country in the world that's just foregone selling treasury bonds?
The example that I'm going to tell you about is Australia, because I know it very well. And the traditional system under the convertible currency was what was called a TAP system of issuing debt. And what the government would do in that system would be they'd decide on what yields they were going to offer, and let's say they'd say 4% or whatever it was. And then they would announce the tap was turned on, and if the private investors wanted to hold the paper at that yield, then they'd buy it. And if there was a shortfall, central bank would buy it. Straightforward. After convertibility collapsed, and it was soon after that we started to worry about budget deficits, and the monetarist surge occurred. I'm talking mid-70s onwards. There was a constant public debate in the sort of among the sort of characters that I hang out with as a professional economist about the dangers of the TAP system. and the dangers of allowing there to be any shortfall at all that the central bank might take up. And it was a really a growing debate, and what happened was in the early 70s they decided that the tap system was dangerous. And they realised that they decided they'd change the system, and they turned to an auction system that was purely available to the private sector. And the auction system then allowed the private sector to determine the yield of the issue. Obviously, the last unit of debt sold would be the highest yield that was being prepared to be paid by the private investor. And they prohibited the central bank from buying any of the issue other than small amounts infrequently for operational reasons. And they soon solved that anyway by creating a support rate, so they minimised the use of that. They minimised the need for that. And you read the literature on this and the government papers, and they separated the debt issuance from Treasury into a separate unit. And if you read all of their papers, they talk about the reason they're issuing debt and structuring it in this auction system way was to maintain fiscal discipline. They knew damn well that the central bank could buy it all. They know damn well. I mean, I know Reserve bankers very well. I talk to them regularly. They know that the central bank could control the whole yield curve if they wanted to. And but they won't, and it's voluntary. They won't because they want to maintain what they call fiscal sustainability, which is the antithesis to what I call fiscal sustainability. As to whether there's any country that doesn't, my understanding is no. But they're all caught up in we're all caught up in the same ideological tangle.
Yeah. Even worse, I was just at a few months ago. I was at one of the guys in debt management at Treasury, and they were extending the maturities of the Treasury, more 30 years, more 10 years. It's like, why are you doing that? We're trying to. Isn't the Fed? Don't you guys want mortgage rates to be lower? Why are you? He says, well, we're worried about downgrades, and the rating agencies have come in and told us if we don't extend the debt, we're risk being downgraded. Okay, so the deeper you look, the worse it gets.
Well, then, as a final comment, and I'll be quiet, many people have blamed this area, the last 30 years in deregulation of financial markets on the mania for deregulating everything of Thatcher and Reagan and people like them. But based on everything we've heard today, it seems that everything else was deregulated at the same time we were hyper-regulating our monetary systems, which is inexplicable.
No, it's not inexplicable at all, because they wanted the whole paradigm and the whole ideology was to create freedom, so-called freedom for the private sector, and hamper the government sector from having any freedom, because you can't trust the public sector, you can only trust the private sector, because the rhetoric is that the private sector is market disciplined and the public sector isn't. It's totally consistent.
Can I just add one thing? Because I think Edward, Lynn, and Roger all have raised a similar point. Do they actually understand the way things work? And so the possibility is, yes, they do. And so we create these myths or frauds because this is how we'll constrain the government, because otherwise the politicians will run away and start growing the size of government. But actually, it is we don't trust the voters. Okay, we don't trust the population. We don't trust democracy. That is what it really is all about, because ultimately that is what's going to constrain the politicians, is democracy.
This may be a digression, but I stumbled on to looking at the Fed balance sheets, which I guess come out weekly or monthly. Why is there gold? They do have treasuries they list as assets or liabilities. Why do they have gold on the Fed balance sheet? What is it there for?
Because they had it before and they don't want to sell it. It's like the national forests or any other asset, but there's no monetary use for it. They do lend it also. There's been some talk that they've been using they haven't been transparent about what they've been doing on the lending side. I don't know what's going to come of that.
Hi, I'm Teresa Sabenko. I'm not an economist. I'm an investigative journalist. That's why many things are probably pretty new to me. But I listened to the President of the European Parliament yesterday. He was just mentioning a few things. But what I learned today, I wanted to ask the panelist if this currency, the euro, is a problem right now. Because that's the way it is, yes? Because there's no state connected to that. Wasn't there enough knowledge that they did that? Or was it something on purpose again that is being created right now? Because where to look for the remedy for this? Because they are right now talking about introducing a common language, which the president is fighting. I mean, is it a scheme or is it just the lack of information?
No, there is an awareness of the problems. In fact, no less than Ottmar Issing from Germany, who's one of the hardliners on he's a practitioner of anti-inflation, strong money, good as gold, etc., etc. He readily conceded that a European monetary union, in the absence of a political union, longer term is not viable. And I think that, but they also realize that politically, the nations, individual nation states within the Eurozone, were not ready to create this new entity called the United States of Europe. And the hope was that the use of a common of a monetary union would ultimately lead to a political union. So there have been these institutional constraints. They've been recognized right from the start. Randy has written about this since the mid-1990s. So has Jan Kregel, another a colleague of Randy's. I've written about it since the early 2000s. Bill's written about it as well. So there is an awareness, but there was a political restriction that I think kept it going. And the question often then arises: well, why didn't they just keep it as a narrow block? I mean, why did they create these problems by allowing countries like Italy and Portugal to come in the first place? And that really goes down. That's a much longer story, but basically you've got three Germanys. You've got the Germany of the Bundesbank. You've got the Germany of represented by people like Helmut Kohl, who believe that you want to bind Germany within broader Europe, within these European structures, and to make it as wide as possible. So there was a political impetus from him, and then you have Germany number three, which is industrial Germany, the Germany of BMW, Siemens, and the like, and they rather like the idea of keeping countries like Italy and Spain in there as well, because they thought, well, we can lock them in at these exchange rates. They won't be able to competitively devalue against us, and so we will help to sustain our competitiveness. So there was a lot of unique political circumstances that drove this, and there was also the problem that you had a country like Belgium, which is essentially part of, in many respects, you've got the Benelux countries, Belgium, Luxembourg, and the Netherlands. And the Netherlands and Luxembourg fulfilled the original Maastricht criteria. Belgium didn't. I think Belgium had one of the worst debt to GDP ratios. It was over 100%. But you couldn't really well have a Eurozone where you allowed the Netherlands and Luxembourg to come in, but you didn't allow Belgium to come in. And once Belgium was allowed in, then the Italians are going to put up their hands and say, well, if they're going to be let in, then we should be allowed in, and likewise with Spain and Portugal. So it became politically unsustainable to pick and choose. Although if you ask the Germans, I think hand over heart they would have preferred a much narrower core Eurozone, and it would have been probably much more workable. Although ultimately you would have still had the same problems, but it's deferred the moment of reckoning. That's been the main issue.
I'm glad you asked the question, because I actually jotted down a little note, something that we probably should talk about, which is that, see, the euro is still a tax-driven currency, so it fits that part of the story. It's tax-driven. The problem is that we don't have the fiscal authority to issue that currency. We have individual nation states, so these are much more like U.S. states. So sometimes I'll get the question, people ask, well, hold it a second, it sounds like there's nothing backing up the euro according to our scheme, and why is it so strong then? Well, it's a tax-driven currency, okay? You have to pay your taxes in euros, and it actually doesn't matter. It's sort of a bizarre situation. It doesn't matter whether the governments default on their debts. The euro can remain strong. Greece can go down, and who knows, the euro might go up. People will be glad Greece has defaulted and is now kicked out of the union. So the euro could be a very strong currency, okay, even while all of the member nations deteriorate and collapse.
Thank you.
Sorry, we have a question over here.
Here's my question. It's about the operational necessity for having treasury bonds. My understanding is that treasuries are used in order to target a Fed funds rate, that you need the treasuries in order to keep the interest rate at a certain level. My question about this is that if you prefer using monetary policy over fiscal policy as a driver of government action, don't you need a constant flow of treasury securities in order to keep on-the-run securities constantly coming in order to keep a liquid market in that vehicle?
Let me bypass the question this way. If the Fed wanted a 2% Fed funds target, it could just trade Fed funds. It could say, I'm too bid, too offered. Banks do whatever you want all day, we'll add it up at the end. So, so looking at it from that point of view, that would be sufficient to target interest rates.
But that's a political non-starter. I mean, they'd never be able to get away with that. They wouldn't do that. Yeah, I mean, right. From a political perspective, that would never fly.
Right. But I'm just saying, from an operational perspective, that's all the Fed has to do is set the overnight rate in terms of, bid and offer, which is what they do in Canada and Australia, where they have a corridor which does that. So from an operational point of view, you don't need treasury securities for that. And now, based on the way we've got our institutional structure, where we use, the Fed has to use the repo market where they're doing, overnight loans back and forth, where they're required to use treasury securities as collateral, then you're correct in that sense. But again, that's a self-imposed constraint. And what we saw after the middle of 2008 was they started expanding that collateral base because using treasury securities was ineffective. And so you saw them overcome this self-imposed constraint through a variety of things, always missing the point that all they really had to do is trade in Fed funds. And you're right, politically they never got there.
Just 2 points on that. It's in 1996 we elected in Australia a Conservative government. Warren will know the story I'm about to tell, I think. And for the next 10 out of 11 years they ran surpluses increasing, and they sold it to the public as rail bridges started to crumble and public education started to crumble, hospital waiting lists started to increase. They sold it to the public as getting the debt monkey off our backs, and because they were obviously retiring debt as it became due. And by 2001, the bond markets were so thin that there was a huge outcry. Now, who did the outcry come from? Well, it came from the Sydney Futures Exchange at the beginning, and all of the other traders that were using the government debt as what I call corporate welfare, basically, as a guaranteed annuity in which they could price their risk off. And this led to the government having an official inquiry. Remember that one? They had an official inquiry onto what the size of the bond market should be, and they were blithely running surpluses all the time. And they agreed. They caved into the pressure particularly from the Sydney Futures Exchange. They caved into the pressure and announced that they would continue to issue debt at an agreed amount. They came up with an agreed amount of millions per quarter, even though they were running surpluses. They continued to issue debt. I thought that was a really lovely. Remember that?
We put a paper in.
Well, that was the official government. That was the Commonwealth government inquiry into the optimal level of debt when you're running a surplus.
And that was a good paper if anybody wants to see it.
You can download it off my research centre, off Coffee's website. Go back to about 2002, December 2002, and you'll see all of the documents and all of the special pleading from the top end of town on why the government had to issue debt even though they were running surpluses, despite the fact, two facts. One is that at the same time the recipients of the corporate welfare were leading the charge to deregulate the welfare state for the workers and deregulate the wage system and get rid of social security. And secondly, despite the fact that these were the ones that were leading, the top end of town were the ones that were leading the myths about the onerous debt burdens, the deficits that they used to run were causing. So that's the first story. The second brief story is that it's very interesting now with Basel III about to emerge, which will change some of the rules relating to the quality of assets having to be held by banks under the capital adequacy regulations. The banks are starting now to suggest that the deficits aren't going to be high enough to produce enough debt for them to satisfy the requirements, and they're starting to pressure the Basel process to allow commercial paper to count as high quality assets in the capital adequacy calculation. So I think that's very ironic.
Plus the idea that you need international bank standards makes no sense.
Oh yeah,
just set your own.
That's another story.
There we go. My name is Jeff Baum. I'm actually an investment manager, so I come from a bit of a operational side. I kind of get the general idea of what you're saying here, and it's all very new to me, so I'm trying to get my head around it. But it sounds like basically you're saying that the government, or in my mind the Fed, can create currency. Therefore, they can spend as much as they need to. I get that. There's an inflation consequence because of this. But I haven't heard too much about what that consequence can lead to. There's obviously some sort of distributional question and I guess that's the political question. I haven't heard that addressed. I don't know if you guys do that or if you leave that for the politicians. But then it just changes the question from, we can't afford this to, what are we going to spend it on? And maybe there is a big question there, as Randall was saying, that, once the voters figure that out, it turns into a big political fight. I don't know if you guys heard, there's some quote somewhere that says, democracy can only last until the voters realize they can vote to the purse strings of the Treasury. So I guess my question is, do you have any kind of summary about how this turns into a political question and what are the distributional consequences of that?
That's a great question.
I think, I'm sure several people will comment, but I think that what the public needs to understand is, if you're saying you want the government to do this, you want the government to spend on this, that means we're going to devote real resources to this. Do you really want the government to devote our nation's capacity to supply you with this? And if you do, then democracy wins and we do it. But you got to realize that means less resources here. Okay? So to get it out of the deficit hysteria, the affordability and so on, it's a real issue. Do we want to devote an ever-rising share of our nation's output to taking care of aged people? Put it that way. And let the population vote on it. They might vote yes, they might vote no. Okay, that's democracy.
Sure. 2 points I'll make. One is that if we get the debate along the lines that you suggested, then we've effectively won the argument, because we've always said ultimately it's a political argument. I've had exchanges with people, and I've written on blogs, and you often get these debates, and ultimately it comes down to saying, look, you are making a political argument. You and I might happen to disagree on the best ways that the government can use the money here, but that's okay. I respect that this is a pluralistic society. We can have differences of views, but let's at least get past the operational issue. And the other point I would make is that even the notion of affordability, it's applied in a very, very selective ways. I'm sure you've noticed. I mean, when we declare war, we don't sort of say, well, are we running a budget balance surplus, a budget surplus, and can we afford to go to war? We just do it. Or We don't say, well, we're going to buy this aircraft carrier, so we better check with our bankers in China as to whether we can afford this. We'll give them a line item of and see if they want to red line anything. Nobody actually ever does that, but that's the logic of their position. If you follow it through to its to the conclusion, but somehow when we get onto a subject like healthcare or Medicare or Social Security, it's like, oh well, affordability becomes an issue. So I think it's more a reflection on our skewed value system than anything else, actually.
Just one point on the distributional issue. One of the things that you hear a lot about now is the growing size of the national debt and the growing interest burden, right? And that, we really need to make that a distributional topic, because it goes directly to this argument that we're passing this on to the next generation, and the generation after that becomes a generational argument, which it absolutely is not. Okay, all of the interest payments will be made by the people who are alive at the time the interest payments come due, and what we're talking about is a shift of income from those paying taxes to those receiving payments because they're bondholders. And so the bigger the share of the interest relative to the size of the economy, the bigger the command of the goods and services the bondholders can wield against the rest of us. And so that becomes a discussion that we definitely would want to have.